Now on 1st January, a business had machinery account showing a balance of rupees 8 lakh and provision for depreciation account showing a balance of 3 lakh 50,000. On the very same date, this machine was sold off for rupees 2 lakh 50,000 and you are required to record journal entries. So let's see, on 1st January 2006, this machinery account would be transferred to machinery disposal account. So it would be recorded as machinery disposal account debited to machinery account. The amount would be rupees 8 lakh. The narration is being balance transferred to disposal account. Similarly, the balance in provision account would be transferred to machinery disposal account on the same date. So entry would be provision for depreciation account debited to machinery disposal account. That is being balance of provision transferred to machinery disposal account, and the amount would be 3 lakh 50,000. On this date, this asset was sold off for rupees 2 lakh 50,000. So entry would be bank account debited to machinery disposal account, that is 2 lakh 50,000, and the narration would be being asset sold off. And lastly, there is a loss in this entry for rupees 2 lakh. This loss would be transferred to P&L account, profit and loss account debited to machinery disposal account 2 lakh. That is loss charged to profit and loss account, being loss transferred to profit and loss account.